Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 is right at about 4180. That is up about 9.5% for the year, so pretty good job, and has been relatively stable up around this 4100 to 4200 range for the past couple of days. So nice range to kind of hang out about in. We've got a couple of different things going on in the marketplace that we will talk about. I'll also just give you a little bit of an update on bond land. The 10-year Treasury is right at about 3.5%. That's about 50 basis points or 0.5% lower than where we were when we entered the year, which is a cute way of saying that your Barclays Ag bond portfolio, or sort of the broad measure of the overall bond market, is up about 1.5% year to date. So far through the beginning of May, at least, market having a reasonably good year with equities up just shy of 10 and bonds up just shy of 2. That is we will certainly take it, for most years. It is earnings season. We are right in the middle of earnings season, so about one half of the companies in the S&P 500 have reported, and I would say that numbers so far are coming in much better than expected. The market continues to kind of look forward and have a lot of fear about, maybe what an earnings recession or an earnings decline might look like in the second half of the year. But certainly for the first quarter, with one half of companies reported, we've been down about 1.7% on earnings and up about 4% on revenue. The revenue number is right in line with consensus, but the earnings decline is far less than feared. Published numbers out there were down about 8% for earnings for the first quarter, and we are certainly well above those numbers. Still a little shy of last year, but certainly better than what analysts were expecting, which I think is one of the reasons why the market has been relatively resilient. In terms of other things that are going on out there, we certainly have the news around First Republic and another banking failure, if you will, although it's not technically a failure since they got acquired. But I think that's probably window dressing at this point. First Republic Bank is the second largest bank to ever fail in the United States. And I think there's a little bit of tale of two cities. On the one hand, it's certainly not a great indication of what is going on in the banking sector right now that we see these types of headlines. Certainly, you'd rather not see them. However, I'd just like to point out that, First Republic Bank lost about $100 billion worth of deposits in the first quarter after the Silicon Valley Bank downfall. And they currently have about $92 billion in deposits that JP Morgan will be buying as part of the acquisition, rescue, whatever you want to call that, which means they lost about half their assets. And it's remarkable to me as an observer that they were able to still stay solvent, that the regulators didn't have to step in faster. And I think it really speaks to the programs that Treasury and the Fed put in place around the discount window and other methods by which banks can access liquidity if they need to kind of shut down the emergency runs. The fact that First Republic was able to hang out for as long as they did, the fact that First Republic was able to eventually spin themselves off to a buyer, really means that I think Fed and the Treasury have been a lot more effective post-Silicon Valley Bank's demise in being that lender of last resort to the banking system, and really kind of takes off the table the disorderly unwind of the space. The fact that they were able to hang out for as long as they did and actually find and acquire is a great thing. It's also a great thing for the Fed and the Treasury because now they don't have to do the whole FDI insurance thing, which, cost about $20 billion in the case of Silicon Valley Bank. Here, the taxpayer winds up not owing anybody a dime since JP Morgan is the one that actually came in and acquired the assets. So, while it's certainly not good to see the turmoil in the banking center, it's good news that they were able to last as long as they did and ultimately be acquired as opposed to being folded. Last but not least, big news is no news out of the Fed this week. Everyone is widely expecting a 25 basis point rate hike. I think in line with the economic data that we've seen sort of year to date, that's certainly expected and probably warranted and justified justified. We haven't really seen any weakness. And all eyes will now sort of pivot towards late May, early June, and the Fed speak that we get here in a couple of weeks around what the next meeting might hold. Some folks think that we may get the rate hike off the table and pause for a little bit. Other people think that we might, hike a little bit more. And all I can say is, let's just keep our eyes on the data, because continued strong data or seeing a little bit of weakness in the data, I think will greatly influence what happens at that meeting. As always, if you have any questions, please feel free to reach out to either myself or to your advisor. I hope you're having a great day, and I look forward to talking to you again soon.